Good morning, everyone. Welcome to the Crypto Investor Roundtable. We've got 40 minutes today to discuss the narrative and outlooks, and we're going to leave 10 minutes at the end for you all to ask your questions, so please do get those ready. I'm joined by a fantastic panel of veterans in the crypto native investing space. If you want to introduce yourselves.
My name is Niraj. I'm a GP at Polychain, where I focus on early stage crypto and liquid investing. We're a fund sort of globally distributed across the US, Europe, and Asia. And we have a strong focus on investing in companies that help accelerate the global adoption of the space. And I have a strong focus on infrastructure investing especially. Before Polychain, I was an infrastructure and sort of privacy researcher at UIUC. I did that for a number of years, and now focus on commercializing that sort of technology with Polychain.
Great. Hi. Thanks, everybody, for joining us this morning and including us on the panel, Diana. So, indeed, my name's Richard Muirhead. I'm the co-founding managing partner at Fabric. My background is that I was really terrible at computer programming, but really excited about what they could do, and built a couple of different software companies, one essentially in kind of web or even internet 1.0 around the network space. I had an IPO with that, helped Axel Partners set up in Europe, and then built a company that was in the whole kind of cloud space, and got super inspired by co-selling with Ben Horowitz. If any of you have read the book, The Hard Thing About Hard Things. Anybody read that book in this audience? Who knows who Ben Horowitz is? Yeah, from A16Z, Andreessen Horowitz. Good to start to understand the crowd. And got excited about the idea of innovating within the space of venture capital and finding out what was the next big wave of technology to kind of be part of, and that led me into kind of Web3 and building Fabric Ventures. And I think we'd all agree the wave is certainly an exciting one to surf, especially in the last 24 hours.
That for sure. So after a really phenomenal 2021 for crypto VC, we've actually seen a downtrend since May and the Terra collapse. And October, we saw continued deceleration. And now we have last night with some unexpected news. FTX obviously facing some liquidity issues, and Binance coming in to help. I'd love to hear your thoughts on that and the potential effects for the market.
Do you want to go? Sure.
Yeah, I'm happy to start.
Yeah, go for it.
So yeah, I think it, maybe wasn't the most surprising given FTX's and Alameda's sort of historical relationship with the market. I think it's just important to say it's obviously very bad for the space, especially for users. Our net wealth is sort of lower as a result, and sort of net confidence in the space is lower. I do think it highlights an important systemic risk with CeFi, which is important to think about. We've not only seen it with FTX Alameda, but 4 or 5 very large crypto entities over the past 6 months, in addition to dozens of others. So I think will be interesting to see what actually happens with the deal, if it ends up going through or not. But I think it is telling us some very important lessons and really testing the sort of solvency of these large, especially CeFi entities in the space.
Yeah, so I think it's always good at these points to kind of remember that you've got to keep hope. And actually, generally speaking, human animals are pretty good at that. In fact, sometimes too good. Like we get carried away with our optimism, a kind of some irrational exuberance. And as we're kind of briefly touching upon sort of backstage, we can lose a kind of an insight into the second and third order effects of our actions. And I think that's effectively kind of what has happened mostly in the context of these big, and I'll use the euphemism that Niraj used, which is sort of systemic issues within CeFi. I think they're also known as people. And I think mostly it's to do with that it's very hard to understand complex systems and an exponential change and second and third order effects, as I said. Occasionally, of course, that starts to blur into fraud or negligence, and I think there are out there such cases, and that's unfortunate. But I think my takeaway from that is definitely that actually we want, for example, more DeFi rather than less. It's not DeFi that is the issue here at all. I think also, we need to retain that hope, but we also need to take a really hard look in the mirror at what we can learn from this. It's an opportunity to obviously make sure we've got the runway to survive. I mean, the first order of business in a downturn is to make sure that you make it through it, and you're not one of the ones who blow up or run out of steam or run out of cash indeed. But we're going to see more of this as the infamous Buffett, or famous Buffett says, when the tide goes out, you find out who has got their pants on and who has not. And I think this is going to continue for a little while longer. So I think we should be mindful of that when we're planning our businesses.
Okay. So bear market's a time for market consolidation. We might be expecting more of that. But they're also a great time for building. So I'd love to hear what areas of innovation you guys are focusing on in the market right now, and where you're seeing deals happen.
Yeah.
So I'll kick off, give the European perspective, so you don't have to go first every time.
Sure.
And then we can bounce back. But I guess I'd first like to say, it's stated a lot that kind of great innovations, great companies get started in the kind of the winter and the bear markets, and I think statistically it's basically very even. And so the point is, don't be put off by the fact that things are tough. And I think even throughout the cycles. And there is something about scarcity and hardship that makes you think hard about how you prioritize, and that can actually often be a blessing. So take the kind of silver linings from the clouds to do that. And I also want to say that we're sitting here in Europe. A kind of subtext to my personal mission or objective over the years has been to show that the opportunity for entrepreneurs, using technology is something that is universal, around the world. And I think we're seeing this steadily in lots of different ways, not just in Web3, but on a sort of secular basis. We're seeing more and more innovation popping up all around, not just Europe, but obviously across Asia and LATAM and so forth. And I think that's not just exciting, but super important for the stability of the planet. So I just want to say that's important. So, please, if you're out there and thinking of building, go and do that. And there's an opportunity in Europe because there's a bit of an arbitrage. This is still a less competitive market for venture firms trying to get into investments than other parts of the world. So the most important thing for you as a founder is not to get the best possible valuation. It's to get funded and to make it through this next period. And so that speaks of an opportunity for everybody. And so maybe and we'll go into it further, to talk about specific areas. Infrastructure, and we can sort of delve into some of the details about things like cross-chain and composition and portability and all that stuff. I think will continue to attract a lot of investment because we're still so early. We've seen such a shift from kind of it's just Bitcoin to, oh my gosh, actually we need Turing completeness and a generalized smart contract platform like Ethereum, and oh gosh, actually we can have contenders to Ethereum too. Like now we have hundreds of layer one chains and a whole contemplation of what that kind of knitted together kind of mosaic of L1s will look like, and what the dApps on it will look like. And so that's a whole new realm of infrastructure investment. And so the other areas that we see people working around is definitely gaming. So this is not surprising because we've seen kind of game economies take off. We've seen people then take hard looks at how play to earn economies can be made more stable. How you don't hyperinflate or hit the skids. That's really interesting because it's deep. It's computer science. It's deep. Economics. It's like, and I see people building super complex models and experimenting at high speed. I think that's exciting, people are doing. But also the usability side of gaming and discoverability. How do I make it totally inconsequential to get a wallet to operate within a game? How do I find different games to operate in? And how do I operate between games? So all exciting areas. And maybe we'll come back to it to give you a chance to pass the baton a little bit. But I think for a long time we've been thinking about the institutions that are going to come and kind of validate the Web3 space as being the financial ones. And Mike Novogratz from Galaxy, and they're an LP of ours, as well as a kind of collaborator on deals, is fond of talking about the herd of institutional investors coming. And I think we're only kind of like one or two bulls into a herd of 100, yeah, it's still super early. And I think that actually the institutions that might come first are actually the media institutions and not the financial ones, because it's easier for them to do that. And I think that the wall of possible innovation, or the kind of barrage of discontent around social media and the possible disruption to sports media entertainment that has happened by this kind of speculative surge around NFTs is a real thing, and I see a lot of sort of important activity around in that space. So sports media entertainment, but also social media in a decentralized format as the ultimate form of distribution for that.
Yeah, that was a great response. I'll try to supplement it as best as I can. I think, to Richard's point a bit earlier, I think something that's important to think about is also sort of utilize the lessons that have been learned in startups before. Obviously, crypto provides a lot of new primitives and tools for developers to build on, but it doesn't change the fundamental gravity of building a startup and building something new. I think what I'm really excited about is finding sort of new novel concepts, things that didn't exist in Web 2 before. And I often look to new sorts of developments in cryptography, new things that happen in layer ones, new distribution models. Those are interesting ways to find where you can have edges in your product and go and actually get a new set of users. I think seeing companies like Polygon, Arbitrum, et cetera, start to develop these really amazing partnerships means that companies are interested in using crypto and Web3 stuff. So that's sort of your challenge, is you need to make sure your product or company is good enough to go get those customers. I think where we're at from a sort of a market perspective is that constraint certainly does breed new creativity. And I think this will be a good sort of market and interesting sort of way to see if your product can sort of outshine what exists before. It's very, very easy to get funding in a bull market, very hard to get funding in a bear market. But if you can get it, that means you've passed sort of the chasm of something interesting. So just, I think, always keep that top of mind when thinking about investing, and I try to keep that in mind when thinking about founders to invest into.
I'm happy to kind of take the ping pong ball back again on that one, because I think it is a super important point. Again, if I am in any sense talking to any founders out there, which is for me the most important audience, is to pick up on Niraj's point that go and try and find stuff that just is not possible in Web 2. Go and build stuff that Web 3 now makes possible. And for us, or for me, I always conceptualize the kind of superpower of Web 3 as this ability to coordinate the few and then the many to take action around quite complex tasks, and importantly, to contemplate sharing activities and data that they would never share before, because, and this is not fully baked yet, but that cryptography is at the heart of Web3 ecosystems, but specifically zero-knowledge proofs, holds out the kind of potential for privacy preservation at scale in a way that we've never seen before. And so whether you're talking about incentivizing people to contribute different bits of narrative to games in return for some kind of upside, or maybe it's a piece of their own life as in terms of some upside within the game economy, or whether it's, we're looking at some of those, or whether it's, incentivizing everybody to give a little bit up of their kind of personal data, there's lots of data about what we're doing, when we're getting up, what our heart rate is, what our blood sugar is, et cetera, on a continuous basis, comfortable that you're giving it up to a network and for the collective good, and not, even to Apple, who's probably got the best reputation in terms of privacy out there. I think, the opportunity throughout, and I'm not a health expert, and that's one of our kind of interesting challenges, is to how to bridge into these different areas, and now it's getting serious, but, through the whole life cycle of drug development and treatment of illness and whatever, there's clearly, data is what it's all about. And so, and then you can see incredible studies where you lift a data set from like a few hundred points to a couple of thousand points, and you create like a kind of from a 20% efficacy to an 80% efficacy in whatever treatment you're delivering. So it's really, really exciting. So I think look for the ways that superpower can be used in Web3 that just wasn't possible in Web 2, and I think hopefully we'll get funded, maybe by us.
Yeah. One quick point I want to add on top of that, I thought it was a great sort of framing, is that I think when you think about markets as a whole, think about it in terms of crypto, you can think about it in terms of the internet, oil, all these historical boom and bust cycles. The earlier you are in the market, often the easier or less things you need to do to become a successful company or product. Simple example, if you were looking for oil 100 years ago, very easy to go stick some stuff in the ground and extract oil. Today you can't do that. Today you need highly specialized fracking machinery, very, very tough market. And I think where we are in crypto is it's still relatively early. 2017, you could just launch a coin, and with the right product, right narrative, you could be very successful. Today, trying to launch a simple DEX on Ethereum probably won't be successful unless you have a very enticing, interesting go-to-market and distribution strategy. So I think to the point about infrastructure and looking for these new markets, look for things that offer these new tools and capabilities, because if you can be early in the market, you have a greater chance of success than if you wait 4 or 5 years. And so you're sort of in some ways making a bet on user behavior and how technology will evolve.
Fantastic. Now let's talk about like the landscape of funds themselves. Richard, you've been in the space a very long time. We met back in 2014 when the conferences were just Bitcoin conferences. Polychain, obviously, as well, one of the longest standing funds in the space. As crypto native investors, with the influx of new investors coming into the space, how do you share those lessons learned, and how are you seeing this landscape evolve?
Your turn to go first? Yeah, go first. Or do you want me to? I'll go.
Okay, I can go ahead.
Okay, you go.
Yeah, I'll try a response then. And then.
That's an example of what's important in Web3, by the way. It's very collaborative.
So I think about investors and maybe what's relevant for people in the room is especially how to pick your investor, how to pick your VC. I think that there's a lot of really bad advice online. Often when they write lists of best investors and things like that, it quite often biases towards who's public, who's active online. And I think that's a component, but I think there's other components that are more interesting. Of the types of VCs, I think what's most important is just strategic help. No VC will ever make a company great. I think that's a really important point. It's the founder that makes the company great. A VC can help you shortcut it. They can help you get great customer intros or tell you to skip maybe a mistake they've seen with other companies. But no VC will ever make the company great. So it's a very important decision, but it's not one that you'll live or die on. I think what's important is to have a really strong working relationship and personal relationship. So much of a VC's role is also just emotional support and guidance as the company is being built. They've worked on tens or hundreds of companies. I work with over 20 or 30 companies on a weekly or bi-weekly basis. So that's an important component for me. And in thinking about how to construct a round or how to pick investors, I think thinking about the strategic sort of specific value they can give you, even from an advice perspective, is important. Can they help get you interesting customer intros? Can they help you hire? Although I think it's, that one's maybe not as important as it used to be. And I think thinking about where a VC fits into your company is very important, and what stage it comes into too. Having a really big VC come in too early is maybe a mistake often, and often having investors, Web 2 investors that maybe are kind of wishy-washy in the space may often be bad. If you start the company and 2 years later they stop answering your emails. So I guess I maybe took that question more as how to pick investors, but I think also there's some interesting stuff just in the evolution of venture as well.
Yeah, no, that makes total sense. And to start off by well, I mentioned earlier one of the things that got me excited to get in the space was to be able to innovate, and maybe I'll come to that in a second about how I think Web3 investing is fundamentally different actually from Web2 investing. I'm not just talking up our book, but I really think it is. We'll come to that. We whether you want to call it VC3 or we call it like venture contributor versus venture capitalist, and so we can expand on that. But going in a sense to reinforce the kind of the essentials, the basics. First of all, I totally agree, you should choose the investor that is right for the stage at which your company is at. So trying to skip around a bit, it doesn't make sense. Secondly, choose the ones who knows the most about your space. Thirdly, try and choose the individual you're going to work with, and be really thoughtful about whether this is going to be a firm that's going to be there for the long run. So whether it's like tourists from the top, like whatever, thinking of a kind of more Web 2 or Web 1 example, like a Deutsche Bank or a Morgan Stanley who kind of drifts into kind of venture investing, or whether it's like a new firm that hasn't got some kind of longevity proven out to it, it can be critical. I suffered from this horribly in my second company, had an amazing individual, Michael Chalfin, now investing out of Chalfin Ventures, great investor, but he was at Apex, and then Apex Partners, they decided not to do venture investing anymore, and so the whole team crumbled, and he left, and whatever. This is whether it's your first, second, or third act, it's probably part of your life's work, whatever you're building. So choose somebody that you want to partner with for that, and a firm who's set up for that also. And if I may, quickly on the innovation side of things, I think. There was this, I've been pitching now, kind of raise funds for our fund for quite a while now. And there was this period when, it was like, well, you can only invest in Bitcoin, so kind of, what could you possibly be doing? You're just insane. And then and that was back sort of 2013, 14. And then obviously the Ethereum ecosystem came along, and people were like, oh yeah, that makes a little bit more sense. But the general sense was that this is super niche-y and super volatile. Is there really enough deal flow for a fund, let alone many funds around the world? And there was probably a day about sort of 1 or 2 years ago when it was just the right sort of size to focus on. But now it's I think expanded into a whole parallel universe that we can address with Web3, and there's a lot to cover. And so I think you've got a range everywhere from understanding pretty deep tech and cryptography and at the infrastructural level, ZK, proofs, all the way through to kind of cross-chain architectures, but then also range out to understanding game mechanics and onboarding of gamers through to the regulatory issues around that are balkanized in the context of health, and so there's a huge range to cover. And as I touched upon earlier, I think the time, although to reinforce again one of your points, Niraj, probably your number one point in your manifesto for being a good VC is to not fuck it up from the boardroom. It's like, don't be like a backseat driver. That's the first thing you got to do, because you got to trust in the founders, like really implicitly. At the same time, there is the potential here for really contributing, because you can be running nodes in the network, you can be contributing content, you can be, creating community and bringing that on board to kind of a new gaming environment, whatever it is, and you can be participating in the very open research that's taking place around kind of the cutting edge infrastructure. So there's a lot of things to contribute to that there wasn't before. And so at the end of the day, you end up covering all of that. You can cover the deep tech, the different applications, be a good investor and stand back, but you've also got to be kind of involved where appropriate. And I think that's actually quite a new model. And there's not only one model probably, but there's quite a new set of models for investing in Web3. That's our thesis, at least.
Yeah, I would absolutely agree with you there in terms of like the amount of innovation that's happening in the space. It obviously also attracts crypto native VCs who also want to be part of that building. I mean, I know for us at 1KX, that can be building sub-DAOs, definitely on the research side as well, hosting conferences, hackathons, and really like actively contributing to this community building for the projects, totally, which is inherent to the nature of Web3 itself.
Until we get eaten up by DAOs themselves, which I don't truly believe, but I think they're part of the future for sure, of the VC model for sure. Yeah.
Absolutely. Are you seeing that as well, Niraj?
Is that to me?
Yeah, to you.
A little bit. I think the most interesting sort of DAO as VC concepts have been the anonymous funds. like the e-girl capital type of model, I think is quite interesting. Both, I think the anonymous part is super cool, but then the DAO part itself, investing into companies, is quite interesting. I still think that there's some open kinks that need to be worked out, from a legal docs perspective. Is there still a company entity attached to the DAO? But no, I think DAOs as investing entities, as one use case is quite exciting, and we're pretty, we're hoping to see more of that. It's still quite early, but definitely like it.
Yeah, I mean, we're definitely, should we say, to say tritely, whatever, long DAOs. In fact, it was, for me, I kind of stumbled into, Bitcoin was earlier, but then mid-2013, it was when I read about the concept of decentralized autonomous organizations that for me, it really okay, my God, this is incredibly big. And it is, I mean, solving governance in a new way that is more equitable, more inclusive, and means that you can tap into all of the talent that you would never hire into a company is, by definition, incredibly powerful, but also by definition, incredibly hard to get right. Mm-hmm. We have a kind of, one of our advisors and a venture scout who was originally part of the core team at Fabric, Anastasia Belaeva, who are building Nation 3. And so they're trying to invest in essentially technologies that can help transform the nation state. Mm-hmm. So not just VC3, but Nation 3. And perhaps now more than ever, we want to be innovating, see if we can find better forms of governance at that level. Mm-hmm. But without getting that ambitious, which ultimately I also agree with or would support, I think that better ways, we can attract more talent, better talent into expert networks, into angel investment clubs effectively or whatever, when you have these open, transparent, and codified structures of governance. Mm-hmm. And I think there's a lot of potential for collaborating. I mean, we're not going to kind of, to emphasize, I think even in those DAO structures, there's a lot, you don't really want to have kind of decision by a committee of 150 people, because you tend to get a reversion to the mean in that. And I believe the statistics will tell you that normally there's actually quite a lot of contention around the most exciting opportunities, and it's normally about the conviction of one or two or three individuals within a smaller set of a small firm that lead to the biggest outcome. So you don't want to have the decision making, but you can have everyone participate still and be included within the syndicates in a powerful way, and be like a super sort of angel investor alongside venture firms and so forth, which I think is one of the roles they can take.
Mm-hmm.
Great. So we have time now to open it up to the audience. 10 minutes for questions. I think there'll be someone coming around with a mic, so we have one over here.
So basically, this cycle had a lot of criticism regarding predatory tokenomics, especially in alt layer ones like Solana, where almost like low float, high FDV is a meme now. What's your thought on how a project can raise capital and have a decent, fair distribution?
I didn't quite get that.
The question that was about tokenomics models and how to have a fair distribution of capital?
Exactly, it's like how to raise capital and have a fair distribution with your community, pretty much.
Okay,
fair distribution to the community when you're raising capital through your tokenomics models. Any insight?
Repeat it one more time.
So with the some tokenomics models have experienced some criticisms, and he's just wondering if there's any advice around how to fairly create those types of models in a way that's fair to the community. Right. Do you have any advice around the tokenomics designs?
Yeah. I might take a stab at it.
Go for it.
I think defining what community means is a very difficult problem. I think, to give you a sort of historical sense of what has happened from a financing perspective in crypto, really early 2000s when Bitcoin first started, the way that it got distributed was through mining. And a lot of people view it to be fair because it was open access. Anyone could turn on a computer, set up a mining rig, and mine Bitcoin. And as we've seen that change over time, and also we see a lot of new types of tokens that are proof of stake based, or tokens that don't have a consensus component but still get distributed. Token distribution is one of the most difficult problems out there. I think the recent context of seeing how community tokens have become a thing really stemmed from the first private token sales in around 2016, 2017, when the SEC started providing a lot of guidance that a lot of these things were not compliant. A lot of token sales moved to being private sales with VCs. And I think this did a bad disservice because ICOs allowed anyone in the world, especially uncapped ICOs, allowed anyone to get access to a token before it launched. I think that was a great token mechanism, and I'm kind of sad it's hard to do, especially from a regulatory perspective. I think the sort of community token allocation we've seen today has become very popular. We see often half of the tokens are given away to a community. But again, I would ask the question, what actually is a community? In some ways, VCs are a community too, or part of the community token allocation. There are a lot of downsides to giving away half of the tokens to the community. They're not locked up, they're anonymous, they often aren't there providing real value to the token, and often they can be sort of rent extractors. So in some ways, I think we need to think really hard about what that actually means, rather than just giving away 50% to an amorphous community, which may just be a couple of whales. I know of several token communities where the community portion was just several large investors. So that's my general view on token economics. I think it's good and interesting to see more innovative models with airdrops and venture contributions. Seeing a lot of DeFi DAOs start to do some things like this, and a couple of layer one ecosystems, especially sort of Ethereum, Cosmos, and a few others. We've seen some very interesting models of multiple teams working on a protocol. So I'm excited to see more innovation in that space. I don't think it's moved quite as fast as I would have liked, but that's my, that's something that we have to work on.
Well said. I'll just try and sort of build on a couple of points. I mean, one is that I saw a narrative that, returning to the pure model of the kind of open ICO was actually maybe the kind of fairest and best way of doing things if we can get over some of the regulatory questions, and maybe we progressively are. I think at the heart of this is the fact that community is part of it's a secret sauce to kind of Web3, right. And so it shouldn't be an afterthought. It needs to be kind of the first thought. Right. And so indeed, what does community mean? Mm-hmm. What does participation in this specific community mean? Mm-hmm. What do you want over time with the community? And I think, as you said, maybe that's lagging a little bit, some of the thinking, some of the tools also. So we've been looking quite a bit at the tools to kind of actively manage community. What does that mean? Who do you reach to? How do you, it's not just a token allocation, but what happens over time? Are they still participating? Can you change the nature of the token allocation over time, have it be more progressive? I think there's a lot of, almost think it was like CRM in the sense of community relationship management, right. For the Web3 era, and then many variants of that I think are pretty interesting. And the heart of that will be, token-based incentives and tokens that are at stake and so forth. So there's a whole extra juice there for to work around. So I think it's going to be interesting. I think there's opportunities for startups, frankly, in that space. And then, and those who do it best are going to reap the benefits. But it's non-trivial, especially because I guess in some senses you have to kind of, and maybe this goes back to privacy preservation. You want to know what people are actually doing and contributing physically as well as virtually, but sometimes that's anathema to the notion of being able to participate sort of anonymously and without having to get it. And so, but maybe if we can preserve privacy in different ways, that'd be good. And I've heard this, to put it this way, there's a lot of interest from some of the big Web2 tech titans in kind of proof of physical work and activity and engagement, and how to bridge proof in the sense of bridging that to Web3 communities. So I think that's going to be pretty interesting as well. It's going to be not just popes, like proof of actual presence of a conference, but other stuff. Was the talk good?
Right.
Great. So we have time for one more question, and competition's tight. Okay.
Thank you. Hi, Patrick Martin, European Media Finance. I have a question. Are you still looking at new layer ones, or are the ones that we have sufficient? And if you were looking at new layer ones to invest in, what would they have to differentiate from whatever is out there already?
New layer ones, are these something you're looking at? What would they need to be interesting?
I'm happy to take a stab again.
Yeah, go for it.
Yeah, I think layer ones are still very interesting. I think the real distinction between layer ones and rollups and app chains and layer threes have really blurred quite a lot. I think again I would go back to the same question. Is it novel? Is it interesting? Does it provide some sort of new distribution, some new developer tool? Certain application features can, in some ways, only really be done on a new layer one, or it's a lot easier to do it on a new layer one. So Filecoin is a great example, or something like Cello that sort of combined both a sort of a front end and back end, was EVM compatible. So I'm not seeing as much as we used to see on the layer one side. But I think what's become very popular is this app chain and app chain as a service concept. If you can sort of own your own community, own your own token, have your own validation, it's become quite an interesting concept for developers. The jury is still out on if that's the right model, but seemingly Ethereum, as it moves to a roll-up centric model and sort of acts as a beacon chain and is basically for settlement, I think that opens up opportunities for new roll-ups that are app-specific or sector-specific. I've seen gaming-focused chains and DeFi-focused roll-ups and things like that. And then the big question for me would be, what's the new security model? I think Cosmos has some interesting stuff on the mesh security that's very interesting. We're investors in this company, EigenLayer, that's allowing you to restake your Ethereum for security, which I think is a really incredible innovation. And several other models that, there's hybrid centralized, decentralized things. So to answer the question simply, yes, but I think it will require more than it used to. And that's why we're seeing less companies being built in the space today, at least that look like what we saw in 2017, which are basically more scalable versions of Ethereum.
Niraj, Richard, thank you so much for your time. Thank you, everyone, for joining.